Now, before I move forward, this picture I came across 2 days back, and I thought actually it speaks about the situation which we have right now, where the president of Ghana said that we know how to bring the economy back to life. What we do not know is how to bring people back to life in this particular situation. Though this particular statement has two parts to it, one being the sad part that human life is at stake, but the other part, which I see as the optimism which all of us should have, is ultimately people like the professional like us, like chartered accountants, lawyers, company secretaries, and cost accountants, who are invariably working through taxation or through other areas directly with the economy. So at least in the past experiences, the economy has bounced back. So if we have that faith and if we keep that thing with us, probably a lot of other things will fall at place. Now with this, when we come to our topic for GST audit of 1819, before that, just for 1 minute, I would like all of us to go back to 1718 and realize that the audit season of 1718, which perhaps has ended for majority of us, though I know few people who are still grappling with the issues of 1718 and still filing the audit reports for 1718, there are few things which all of us have learned from the 1718 audit period of GST. And some of them which I could summarize was that this 9 and 9C forms which have been filed, they have been filed by all of us in a very customized manner, in a sense that we have interpreted these forms. And interestingly, there have been interpretation of the fields in the form, and all of us have taken a position which we were comfortable with, and we thought that we'd be able to justify. At the front of the accounts and records, probably what has happened is that all of us fairly were able to get the record in respect of outward supplies properly. And finally, we cracked the code in a sense that we were able to have the outward supply register, which is probably required for initiating that audit. However, the problem was, and which all of us faced, specifically the experience which I had, was in respect of the inward supplies and the details of ITC, wherein probably the required fields which are important for the purpose of analysis and also for the purpose of proper presentation were not there, or even if they were there were a lot of persuasion and a lot of efforts which went into it to ultimately have to have an ITC register. One of the important tables of annual return, table 8, though it started with the confusion was that what is the importance of the table, what will happen if in case I have an unreconciled figure, to what extent it will have repercussions. But ultimately, all of us settle with an understanding that it is only for the information purpose, but it does not have an impact directly to the tax liability. Further, reverse charge mechanism was one thing where probably a lot of us have given a lot of observations, a lot of recommendations, and in fact, Part 5 of 9C was used majorly along with other issues for reporting what tax liability in respect of reverse charge was not discharged by the assessee. And assessee, in fact, also got an understanding that probably the credit in respect of reverse charge mechanism can be taken at a later date, though there are different views in this respect also. So people were quite comfortable in a sense paying that RCM during the course of audit, and majority of us have also taken the credit in that respect. But one very interesting thing which has happened is that since the audit 9C report and along with other documents have been filed on GST portal, within 1 week or so, the audit notices from the department started coming. And in fact, in few of the cases, at least in case of large assessees, the audit has been completed by the department. And there has been a great trust by them on what has been written by us in our GSTR 9C and what observations have been given. And those observations have been tried to actually deep down pondered by them to see what are the revenue leakages. One thing which generally came across to them was in respect of the documents and invoices, where all those people had given an observation in respect of that RCM invoices or self-invoices were not prepared under section 31(3)(f). In all those cases, audit paras for disallowance of input tax credit has been given by the department. Now, with this background, that whatever we have learned and whatever things have happened, when we come to 1819, it is very important, I thought, that first of all, we look at all those documents which are available with us, in a sense that there were some relaxations which were given for 1718 and 1819. And though we have used those relaxation in terms of the non-mandatory filing of the forms, or in respect of how the figures are to be punched in the forms, what impact precisely it brings in when we'll do this filing of annual returns and audit reports for the year 1890. So first thing first, that is the due dates, which is important, that I'm sure all of us are aware of, that through notification number 15/2020, the time limit for filing of annual return and reconciliation statement has been extended in general for every SSE up till 30th of June 2020. So as of now, that's the due date through which we have to do the filing on GST portal for the financial year 1819 and 1920. Now, the basic law in this respect, which all of us are aware, only for the purpose of background, that almost all registered SSEs, except a specific class of them, doing specific activities, are not required to file the annual returns. Otherwise, all registered SSEs who do not have a turnover beyond 2 crore, aggregate turnover beyond 2 crore rupees, are only required to file the annual return, and all those who have a turnover beyond 2 crore rupees are required to file the annual return along with GSTR Form 9C and the audit report. So that's the basic section and the rule that has been written. However, now in respect of 1718, which has been passed, in 1819, there have been changes. And from here, now various permutation combinations in respect of various class of those registered SSEs develop, wherein there are few people who are required to not file anything. There are few people who are required to file only annual return, and there are few people who are required to file annual return and audit return. So in this regard, first of all, notification number 47, which came in October 2019, wherein in a very interesting manner, an option to file annual return was given. So through this notification, which was issued under section 148, the option not to file annual return was not given, but in fact, vice versa. An option was given to all those people whose aggregate turnover in a financial year did not exceed 2 crore rupees to not to file annual return, to actually file the annual return. And in a very interesting manner, a proviso was added where it was said that if in case the return shall be deemed to be furnished on the due date if it has not been furnished before the due date, which kind of gave a sense that all the SSEs which are actually required to file the annual return are doing the compliance. Only those SSEs who are taking the option under notification number 47 are filing those annual returns by themselves, and all those who are not taking the option are actually not filing the annual return, but that is deemed to have been filed either by the system or by the department or through some another mechanism, which probably at the time of assessments, probably at the time of replying to the notices, all of us would get a clearer and a better picture to it. Circular 124, which clarified the position which was given in respect of notification number 47, that all those people who do not file this beyond at the specific dates and not having a turnover beyond 2 crore rupees would not be given an option to actually file after the due date. Now, once we look at it, so we realize that there is an option for all those people having a turnover less than 2 crore rupees applicable in the financial year 1819 also, where they need not file their annual returns. But for all those people who have a turnover beyond 2 crore rupees and who actually file annual returns along with getting their books of, getting their audit done and also filing a reconciliation statement, for them there is a new class of SSEs which have been added by insertion of proviso to Rule 80 Sub-Rule 3 by notification 16/2020. And this came just a day before when the nationwide lockdown was announced. And this proviso, in principle, it actually tries to explain that for the financial year 1819, all those registered persons who have an aggregate turnover between 2 crore to 5 crore rupees. In fact, it doesn't use the word between 2 crore to 5 crore, but it says whose turnover does not exceed 5 crore rupees, they are probably not required to file the audit report. And I use the word probably because once we go and read this proviso with 80 Sub-Rule 3, it kind of brings in a new picture. But principally what the understanding which has been given by the council and the purpose of this proviso has been brought is only those people whose aggregate turnover exceeds 5 crore rupees are actually required to get the account audited and file GST and 9C for the financial year 1890. Now, once I say that, it becomes very important that we read Rule 80 Sub-Rule 3 along with the newly inserted proviso. Now, as we understand that proviso through this common, the rules of interpretation is treated as an exception. That is, it is carving out an exception, or it is taking a specific situation from the general provision which is already written there. So when we read 80 sub-rule 3, it says every registered person whose aggregate turnover during the financial year exceeds 2 crore rupees shall get its account audited, and then subsequently are required to also file Form GST and 9C. When we read the proviso, in a very interesting manner, the proviso reads that every registered person whose aggregate turnover during the financial year 18-19 exceeds 5 crore rupees shall get its account audited for the financial year 18-19. Now, a question which somebody who would like to interpret the way it is written is that all those assessees who have a turnover between 2 crore to 5 crore rupees, are they actually taken away from this proviso, or are they still covered in this 3? Or is this proviso actually missing a specific word while through in his drafting, wherein probably if word only would have been added somewhere in this proviso, it would have got a very clearer picture in a sense by saying that only those assessees who have a turnover beyond 5 crore rupees are required to get their account audited and file GST or 9C. Though with the purposive interpretation of this proviso is quite clear, though the council has also made it quite clear, but when you actually try to read the rule, it kind of gives an understanding that those people who have a turnover between 2 crore to 5 crore rupees are probably somewhere still lying in this rule 80 sub rule 3, and there is kind of non-comfort which is there when somebody would like to read and try to find out, are they actually taken out from this rule 80 sub rule 3. But as I said, that because the intentions have been made clear, we understand that if in case this issue arises, and probably if it reaches to the lawmakers, probably a correct clarification in this regard would come, and they would say that clearly what they meant was actually what they wanted to write in the specific proviso. So this brings to that particular situation where we are today and what we have to do, where we have to classify our clients in 3 broad categories, where all those registered persons who are not ISDs, CTPs, NRTPs, or deducting TDS or collecting TCS, and having a turnover not exceeding 2 crore rupees, they have the option to file annual return. If in case they don't exercise that option by the due date, their annual return shall be deemed to be filed. All those who have a turnover between 2 crore to 5 crore rupees, they have to file GST and 9, that is annual return, in compulsorily. However, they are not required to get their the audit done under this GST, and also not required to file GST and 9C. And all those who have a turnover beyond 5 crore rupees in financial year 18-19, they are required to file annual return and also file 9C along with the audit report. So that's precisely now the 3 baskets of assessees which have been created for the financial year 18-19. Mind you, the proviso which has been added to 80 sub rule 3, that is specifically for the financial year 18-19 only. It is not applicable for the subsequent year until unless there is an announcement or there is an amendment in this regard. So once we see this, a question which comes in mind, which probably would have cropped up in everybody's mind in financial year 17-18 also, for all those assessees who are having a turnover less than 2 crore rupees, should they actually exercise the option of filing the annual return, or it should be treated as if it is deemed to have been filed? Now, mind you, deemed to have been filed is actually means the compliance of law has been done, not by the assessee, but it has been done by a deeming fiction. Now, why am I saying that is that there is section 74, and in section 74, explanation 2 is there, which actually kind of explains the meaning of word suppression. And that suppression, the way it has been written, it says non-declaration of facts or information which a taxable person is required to declare in the return, statement, report, or any other document furnished under this act or rules made thereunder. Now, the important thing to understand is all those who are not filing annual return, their return is still being furnished under this act. This doesn't, that if they are not filing, that doesn't mean that the return is not being furnished under this act. The return has been furnished. So now take an example. If somebody is not opting the option of filing annual return from their side, and if in case system is punching the figures for whatever limited information that system has, which probably might have an incorrect information also, or an overlap of information which is coming from financial year 17-18 also, then in a stricter sense, nothing stops the tax officer from using this explanation 2 of section 74 and using the expression suppression, where during the course of assessment he realizes that there are some taxable supplies which should have been reflected in the annual return and have not been reflected, or there is some input tax credit which should have been reversed and has not been reversed, and assessee only in a bona fide manner did not file the annual return using that notification which is there, and then he might go ahead and invoke this particular expression, and the penal provisions in that regard would be different, and assessee would have to, in that case, save the case by saying that he did not intend to suppress anything in this regard. So that's why a conservative advice which came in 17-18 is also prudent in financial year 18-19 also, where it is being said that because these are this is initial years of GST 17-18, 18-19, and probably 19-20 also, all assessees technically should file their returns by assessing their current tax liabilities, and proper disclosure in this regard should always be made, so that the this tool of suppression, which the way it has been worded looks very dangerous, would not be invoked by the tax officer. Now, once I say that, it is very interesting to see that last series of document which was there, which is applicable for 17-18 and 18-19 in regard to annual return and audit, is notification number 56, which kind of gives relaxation to all the assessees who are filing, irrespective of their size or their turnover, whether they're getting audited or not, in terms of disclosures they are required to make. In a sense that it says that reporting of certain things are made optional, and assessee, if in case they are able to reasonably prove and they are reasonably able to support through their documents, can do a consolidated based on reporting. And that consolidated reporting, specifically in terms of annual return, the key points which are there, which have been relaxed for financial year 18-19 also, that in annual return, reporting of credit notes and debits note separately have been made optional. In fact, amendments also need not be reported separately. They can be done in a consolidated manner. Interestingly, the overlap exempted supplies, nil rated, non-GST, no supplies can also be reported in a consolidated manner. Here, one point which I would like to bring is that there is a lot of questions which came in 17-18 for all of us, whether to actually report no supply, not to report no supply, and what is the coverage of no supply. After the press release which came in July 2019, all of us settled through this to this point that actually the transactions and the activities which are specified in Schedule 3 can be treated as no supplies. The question which arose was that actually those no supplies should be disclosed or not. And my personal view in that regard would go that if in case a form specifically requires an assessee to disclose something, be it in a consolidated manner, be in a detailed manner, and the same is not disclosed, that in my view would not be the correct interpretation, just by saying because that transaction or an activity is not a supply, it is outside the purview of GST, and hence I would take the view of not reporting it. Because it is a reporting requirement, and reporting requirement has been mandated, hence in my view all the no supply transactions which have been undertaken in course of business, which are reported in Schedule 3 and forming part of books of account, should also be reported in 18-19, even if they have been, a conscious call has been taken of not reporting them in 17-18. Then one of the biggest factors in which majority of the assessees grappled in terms of bifurcation in input tax credit in respect of input service and capital goods not required to be given. Similarly, reversals of various types, they can be given in a consolidated manner. A very interesting thing added, which is applicable for 18-19 also, is that table 8, where reconciliation with GST are 2A, and it was told that if because the data which was coming in table 8A, the source of that was ambiguous, and a lot of people had a challenge in understanding from where that data is coming. So an option was given to separately upload table 8 in a PDF form along with form GSTR 9C, where the signature of the chartered accountant or attestation by a chartered accountant was not required. That same option is available still, and we'll see that in the later code, that whether that option should be used in 18-19 or was that only limited or useful for 17-18 only. Interestingly, the filing of details in table 12 and 13 in respect of input tax credit, which has been reversed in subsequent year pertaining to 1718, and input tax credit which was availed pertaining to 1718 in the subsequent years, that was made optional. And I think when we go ahead, we realize that this optional table, if in case that option of was exercised of not reporting it, probably it poses huge challenges for us when we'll do this filing of 1819 annual return. And then other informational tables of 15, 16, and 18, they were also made optional. And lastly, in this notification number 56, in terms of GSTR 9C, two welcome changes which were there. That is, in terms of that reporting was to be made in respect of true and fair now instead of true and correct, and cash flow statement, for which was very difficult to be attached for non-corporate assessees, that was made optional. In terms of adjustments which were done in the turnover as per books of accounts and details of supplies which was flowing from annual return, and then in terms of adjustment, it was asked that those adjustments can be reported in a consolidated manner. Now, again, in this regard, one of the practical challenges which we faced while answering to the departmental audit in respect of 5.0 was that in one of the cases, the option was exercised and consolidated reporting was done. And when the audit officer asked for that detailed working, so that detailed working was available with the assessee, but it was not available in a presentable manner. So that explanation in 5.0 was given to the audit officer. The audit officer took those details, and finally, when the audit report came, he made one of the audit observations was that the information for adjustment has not been provided in a proper manner, and hence the difference of turnover and the difference which is coming in annual return, they wanted to treat it as a supply, the details of which have not been explained neither in the audit nor during the course of departmental audit, and hence the para was made. Though that para prima facie looks illegal, but still that action was taken by the departmental officer. So caution in this regard may also be taken. And in 9C, last change, that option which was given in respect of table 12 and table 14, where some of the fields were made optional. Now, in this background, where there are three classes of assessees for who have to do at filing at different levels, and the filing which needs to be done, it has some options available where we might have exercised some option in 1718, we might not have exercised some option in 1718. When we come to that, and when we take up the data for financial year 1819, we see that there are some challenges which all of us would have. And I'm sure all of us are aware that financial year 1819 is that year where for the first time we'll have baggage of the previous year. So because 1718 being the first year, technically we did not have to worry whether there was any supply in the previous year, the effect of which was required to be given in 1718. The only worry which we had in 1718, on which all of us tried to scratch our heads to understand that what effect of all those transactions which have not been reported in 1718, how and to what extent they should be reported pertaining to 1718 in subsequent years, and in what tables, specifically table 10 and 11 of annual return, how it should be used, and how GSTR 9C, the unreconciled differences should be reported, that is the transactions which are either not reported or subsequently reported. Now in this year, all that adjustments of 1718 which we had done, and not probably thinking during that time that what effect it is going to have in 1819, brings out some very interesting situations in front of us. So now when we talk about the outward supply in annual return, the first and foremost question which generally all of us had is from where the data would come. And principally, more or less, after this press release, though press release did not lay down the path very clearly from where the data would come, but all of us understood that GSTR 3B would have a supremacy over GSTR 1 when we will be punching data in annual return. And most of us have adopted that technique. May probably details in specific columns of table may be here and there, but GSTR 3B was taken as a pivotal base, and that 3B and comparison of same with the books of accounts was actually the basis on which we had proceeded to file our annual return and then making the reconciliations in form GSTR 9C. Interestingly, this press release, it only talks about that what one assessee is supposed to do in annual return is, if tax has been short paid, is required to pay the necessary tax. And if in case tax has been excess paid, in that case, he is probably required to file a refund in that case. This press release to that extent has clarified the situation. So taking the basis from this, at least the approach which I will use while taking various examples of reporting which all of us have to do in 1819 is that what approach all of us would have followed, or majority of us would have followed while filing the data in 1718 in brief. So the facility of consolidated GSTR 3B was given on the portal, where all of us took that consolidated GSTR 3B. We might have compared that with figures of GSTR 1. Some might have ignored the figures of GSTR 1. And we compared that with the figures which are there in the books of accounts on consolidated basis. And those books of accounts ultimately culminate into preparation of an outward register. And on the basis of that, all those details which were matching, which were there in the outward register and also reported in 1718, probably a conscious call was taken that same shall be reported in table 4 and 5. That is the outward taxable supplies and exempted supplies and the supplies export of goods made into LUT. So table 4 and 5, after matching of data which was there in the outward register or ENS books of accounts and GSTR 3B of 1718, that was punched in table 4 and 5. Now, whatever difference was left over, and interestingly, in 1718, the difference could have been that probably there is over-reporting in GSTR 3B or there is under-reporting in GSTR 3B. So whatever under-reporting or over-reporting, that table 10 and 11 technically took care of it. And all of us tried to see whether the adjustment in table 10 and 11 could be made. And if it was possible to make, and if in case the details in the subsequent returns which were filed in 1819 had sufficient figures to cover this unmatched data, in that case, we have used those tables, table 10 and 11. In all this process, GSTR 1 probably was not the base, though it was not completely ignored. But if in case the details were completely unmatched in 3B and 1, in that case, 1 was not given the priority over 3. In that context, now when we come in 1819, there is some challenge if in case this approach is followed. And that challenge probably can be understood in a manner only when we try to revisit actually what is the reporting requirement which this table 4 gives. So now the reporting in GSTR 3B, and in fact that press release also said that 3B is a return now, practically after that retrospective amendment to the rules, is a return where the liability to pay tax and in fact the tax paid is disclosed. Now if you look at table 4 of GSTR 9, it says, and part 2 starts with details of outward and inward supplies made during the financial year. So it talks about the outward and inward supplies. It not uses the reference of tax in this regard. And when you read table 4 specifically, in which the data has to be punched in various columns, it is very clear to say that details of advances, inward and outward supplies made during the financial year on which tax is payable. So tax payable is secondary. The details, the first priority in respect of the outward supplies made during the financial year. And then when you look at it and you see it in the context of financial year 1819, the first question which grapples with everybody's mind is, okay, if let's say the approach which I followed in 1718, if I try to follow it again, then the first question which would come is, there will be an overlap of data which I had punched in table 10 and 11 of GSTR 9 of financial year 1718. That is all those details which were reported in GSTR 3B, which were filed in 1819, but supplies actually pertain to financial year 1718, which to an extent is true. So am I actually again required to take that in table 4? The way I would look at it is in this manner, that probably this year and from here on and for subsequent years also, that approach of punching the data on the basis of GSTR 3B in respect of outward supplies would not work, but probably all assessees would have to now actually identify the outward supplies they made in that particular financial year in respect of which the annual return is going to be filed. And that brings a very interesting point, because When you look at table 10 and 11 also, in the context of financial year 17-18, not in the context of 18-19, when you look at it for the previous year for which we had filed, it says that particulars of transactions for the financial year 17-18 declared in returns between April 18 to March 19. So in fact, we are also declaring in this part 5 all those transactions which actually were related to financial year 17-18 only. And when you read it and you read table 4 for table 18-19, you realize table 18-19 only talks about the details of outward supplies which have been made during the financial year. Hence, taking on the basis of this, in my view, the approach which can be that one can still start with GSTR 3B. However, he can compare the figures which are there. Only after comparison, the details which are there in the outward register and details which are matching with GSTR 3B, that is to the extent of figures which are also punched in 3B, can be only put in 4 and 5, and rest unreconciled differences. That is, details which are either there in outward supplies but not there in returns, or details which are there in returns but not there in the outward supply register. In that case, all those details which have been punched in the subsequent year, that is the returns which are filed for 19-20, can only be taken to table 10 and 11 of GSTR 9. Hence, precisely the proposition which I am trying to build upon is that in financial year 18-19, the outward register or the books of accounts would have the supremacy, and they would be the pivotal point, but not GSTR 3B. And on the basis of that, whatever is matching in 3B would come in table 4 and 5, and for rest others, like earlier years, the approach which was followed, that balance difference can be punched in 10 and 11, that blanket approach cannot be followed in financial year 18-19, and all adjustments of 10-11 which have been done earlier, they have to be excluded while we are filing the details in table 4, 5 or 10-11 in respect of outward supplies in 18-19. If that approach is followed, probably once we'll go and match these details in GST and 9C in books of accounts, what has been reported in the books of accounts in respect of the turnover, we'll have a clearer and a better picture. And also, we would not be unnecessarily writing our observations in respect of unreconciled differences and unnecessarily mentioning about those transactions which pertains to 17-18. Now, having said that, this probably looks a doable and a workable solution. But when you come to table 9 in respect of that, this was in respect of what we are supposed to write for the turnover which needs to be reported in GSTR 9 in 18-19, that what approach needs to be followed. When you look at the tax impact, in a sense, how tax reconciliation needs to be done, that is, I'm talking about now table 9 of GSTR 9, that is, that table 9 in which the details of tax payable and tax paid are punched. In that case, we would have a lot of situations, and there would be few cases where all of us would have to take a call. So I have listed down few cases that how reporting would have happened in 17-18 and what impact it is going to have in respect of tax reconciliation in 18-19. So case 1 is, let's say somebody had a taxable value of 1,000, tax payable of 100, and by mistake in GSTR 3B and the tax of 110 was paid. And subsequently, in light of the press release of July 2019, the assessee filed for a refund claim. So it looks like not a likely situation where somebody could have filed a refund claim, but let's say in exceptional cases, the people have not adjusted the tax and they have filed a refund claim. Now in 17-18, the reporting would have been in this manner, that in table 4, taxable value would have been reported as 1,000, tax payable would have been 100, which was the actual tax payable. When you go to table 9, tax payable would have flown as 100, and tax paid would have come as 110 because in GSTR 3B an excess tax of 110 was paid. So it would clearly would have brought a picture in 17-18 where tax paid was 110 rupees extra. However, this is that case where no subsequent adjustment in GSTR 3B for financial year 18-19 was done. It was a pure case where a refund would have been filed. In that case, when somebody would file a refund, return for annual return of 18-19, and let's say assuming that in 18-19 taxable value is 1,200 and tax payable is 120, probably these type of cases would not have any spillover effect, because no excess tax or no adjustment of tax would have taken in the subsequent returns. So for GST or 3B, and for the timing for this example, I'm assuming that there is no other adjustment in the returns. I'm taking a very plain vanilla example just to explain the spillover effect of various adjustments of previous year which will be there. So assuming that there is a taxable value of 1200, tax payable of 120, and tax paid for that year is also 120, that excess tax of 10 rupees would not have impact in 18-19, because assessee would have filed a refund claim rather than actually making an adjustment. And in this sense, the 18-19 reporting would be simplistic and clear, and it would be without any explanation. However, now once a case is taken where the refund has not been filed, but rather a subsequent adjustment has been done, and table 10 and 11 have been used by the assessee. In that case, then it would bring a lot of interesting pictures, and in that case, the call has to be taken by the person who is filing annual return. So in this case too, let's say for 17-18, tax payable was 100, tax paid was 110, and this 10 rupees tax was subsequently adjusted. That is the tax for the subsequent transactions which took place in 18-19. That is the supplies which were ought to be reported in GSTR 3B of 18-19. The assessee took a conscious call, and he decided that because the tax of 17-18 has been paid extra, they would not pay that tax to that extent in 18-19. So now what would have happened is, in 17-18, either of the two options would have been followed by the assessee, where either the option which looks correct or not correct in fact, but a favorable option would be an option 1, where assessee would have reported in table 4. I'm talking about 17-18, but not 18-19 right now. So in 17-18, they would have either shown in table 4 as taxable value 1000, tax payable as 100, and in table 9, because the payable and paid would the payable would have been lesser than tax paid, hence there would have been a difference of 10 rupees, which would be evident in that case. Option 2, which could have been followed if in case the approach which I had illustrated in the starting of the flow chart, if that option was followed by heart, in that case in table 4, tax payable would have been reported by an extra 110, and tax paid would also have been 110, and then subsequent adjustment would have been done in table 11, where the tax payable would have been reported by -10, that is reversal of the additional or reversal of the values, because the value has been reported correctly, but the tax payable has been reported with an tax payable was reported extra in table 4. Hence, in table 11, this would have been reduced by 10. So ultimate effect would have been 110 minus 100. The overall liability of tax payable would have been 100, but tax paid would not have changed, because table 9 remains static, and tax paid, and in table 14, that is whatever subsequent the details of tax we write in table 10, 11. In table 14, we cannot write the figures in minus, and the tax paid could not have been written in minus in that case. So tax paid would have remained 110. Now, when you take this, which has its spillover effect in 18-19, and when you take the figures of 18-19, the same simple vanilla example where we say that 18-19 was an idle year, where my taxable value was 1200 and tax payable was 120, and I wanted to pay a tax of 120, but because I had paid an additional tax of 10 rupees in 17-18, hence in my GST or 3B, I did not pay a tax of 10 rupees. And hence the tax paid through GST or 3B would be 110. In that case, there will be two things which would be interesting. So probably again, what approach would assessee would have followed is, you would have shown in GST or 3B of 18-19 correct taxable value, but tax payable would have been shown by lesser amount, because so that only in GST or 3B, whatever is payable, if it is unless completely paid, 3B is not filed. So he would have shown a tax payable in that case as 110. Now, when we come to GSTR 9, in this case, the approach, according to me, which should be followed, or which would, according to me, would be a better approach, is you go to table 4, write taxable value complete, write tax payable and the taxable value complete. When you come to table 9, the tax payable would flow from table 4. And when you go to tax paid would come from GSTR 3B as 110 only. In that case, there will be a difference which would be apparent on which would be on the face of GSTR 9 in table 9, where it will say the tax payable is 120 and tax paid is 110. Now, this would probably raise a question in all of our mind that in this difference, how this difference is supposed to be reported. So there can be three possibilities, and maybe we can explore at these out of these three possibilities that what approach can be followed. One is that we do not report the taxable value and tax amount of this 10 rupees extra, which has been already paid in, which has been already shown in GSTR 9 of 1718. According to me, that would not be a correct approach, because when you read the heading of table 4 of GSTR 9, it says details of outward supplies. So it is not, it has no linkage as such with on the tax payable. It's a details of outward supplies and tax payable thereon. Hence, the proper amount of tax payable of 120 should be reported. Second thought process which can come, and all these options come with where I started with, that we have filed our 9 with customized manner. So the second thought which may come is, okay, so my tax paid in table 9 cannot change. Why can't I raise this difference of 10 rupees in table 14, so that to whomsoever I'll explain my GSTR 9 for 1819, mathematically I'll be able to explain the total, that this 110 is written in table 9 and 10 rupees is written in table 14, which technically I should not have written in table 14 of GSTR 9 of 1819. But because there is no other option available in the form, hence I'm writing this so that I'm able to explain this. According to me, that would also not be the best of the approaches to follow, because table 14 has a very clear mandate as to say that until unless we are showing any transaction in table 10 and 11 or necessary adjustments there, the tax paid in this respect should only be reported in table 14. So that leaves us with the last option, and the last options according to me would be that let this difference remain as it is, and then when you file your GSTR 9C, if in case these are all those cases where GSTR 9C would be filed, then along with the GSTR 9C as an annexure, whatever additional notes are being given, maybe because for table 8, the government has itself said that your table 8 can be uploaded in a PDF without signature of the chartered accountant. In a similar manner, for these type of transactions, the assessee can annex an additional note to explain that why this difference is there and why it should be read with GSTR 9 of financial year 1718, and how this difference of 10 rupees has already been reported in the earlier tables, that is table 11 of GSTR 9. According to me, that is a fair approach. No doubt this approach would take time for department to understand. They might have a lot of patience. They might not be able to actually link between both these things. But according to me, that would be a fair approach, because proper figures should be reported in the appropriate table. Wherever there is a difference and there is no possible explanation available which can be given, a note in this regard can be appended. I'll take another example in this case where the tax has been subsequently paid. Case 2 was where an excess tax was paid. This is the case where tax has been subsequently paid where tax payable was 100 on the taxable value of 1000 and tax paid during 1718 was only 90. In this case, the approach would have been followed is that necessary tax would have been shown in table 10 and necessary tax payable should have been shown either in table 10 and tax paid would have been shown in table 14. So necessarily in GSTR 3B of 1819, this tax of 10 rupee is coming along with the other taxes which relate to 1819. But this tax of 10 rupees has already been reported in GSTR 9 of 1718. Now, when we take this example and when we come to the figures of 1819 or filing the annual return, the situation which comes up is that when we try to collate the data for table 4 of GSTR 9, for 1819 and taking again the same figures as 1200 and 120 for 1819, in that case tax payable would be absolutely perfect as 120. But when we look at table 9, in that case tax paid would automatically populate as 130, and in this will show a situation where tax paid would be extra than tax payable. And again, this may raise a question, and this has to be kept as one of the notes by the person who is preparing the annual return or conducting the audit. When they do the annual return for next year, that is 1920, there is additional tax which is coming earlier, that how it has been reported. So again, there are two options. One is that to ensure that this spillover effect is explained through numbers here, why not to increase the tax payable by 10 rupees here? But as I said earlier, it would not be a correct approach because tax payable has to be in respect of the outward supplies which are reported in table 4. Hence, the tax payable should only be commensurate to that. Hence, it should be 120 only. Then the last option which is remaining, which we followed, which I believe should have been followed earlier, is that necessary note in this regard should be annexed with along with 9C, wherein the difference of 10 rupees has to be explained. So when we look at these two scenarios of impact of table 10 and 11 on the outward supply, we come to a conclusion that probably reconciliation of taxable values would be comparatively easier. But this year, for financial year 18-19, reconciliation of tax payable and tax paid would take some of our efforts and time and obviously the management of data so that we're able to come out clean. And a reconciliation of this sort, sorry, one minute. Yeah, a reconciliation of this sort can be a reconciliation of this sort, which is on your screen, can be done by the assessee. So what is this? That when we are trying to reconcile tax payable and tax paid, we are not reconciling the taxable value because for that we have followed a separate approach, which according to me looks a very easy and a convenient and a correct approach. But this, because of the restriction of table 9, what can be done is that total tax paid can be taken as a basis, which is there in GSTR 3B to start with, and it is going to be a separate reconciliation which should be prepared by the assessee. And then necessary reduction of tax which was short paid in 17-18 but which has been paid through GSTR 3B should be reduced from that amount which is there in serial number 1. And then if in case any extra tax of 19-20, that is all the reporting which is to be done in the subsequent table 10 of GSTR 9 for 18-19, if at all that has to be done, then any tax related to that has to be also reduced. And after reducing that, two things which should be added, that is any excess tax which was paid in 17-18 and now it is adjusted to pay the liability of 18-19 should be added, or any tax of 18-19, that is, or any tax which is on a specific supplies which is payable on 18-19, which has been paid subsequently and shown in the subsequent table 10-11 of GSTR 9 for 18-19, that needs to be added. So there are two things which should be reduced from the total tax which has been paid in GSTR 3B in 18-19, and two things which should be added in that particular figure to reach to a figure which should ideally match with tax payable which is coming in the outward supply register or maybe the outward tax liability which an assessee might have in his books of accounts. So if that figure is 0, that means that would be the result which is coming in serial number 6, which is on your screen, would be actual tax payable in respect of the taxable tax paid in respect of the tax payable which is there in serial number 7. However, there is a difference. I mean, this serial number 6 and 7, they ultimately in serial number 8, the figure is not 0. And there is a difference. Then in 18-19, there could be 3 possibilities which could be there because of which the figure is not 0. And one is that there might have been some tax which has been paid through through DRC 03, which is not populated in table 9. And that has to be looked separately. Or there is actually an additional tax which has been paid by the assessee, which was by mistake and which was not realized during the year, and due to which the difference is coming, for which actually refund has to be claimed. Or last, there is any input tax credit which has been reversed by the assessee and that has been paid, but which does not have any impact in the outward tax liability of the assessee. So beyond these 3 reasons, probably there may be other reasons, but I could only comprehend these 3 reasons that the details which is there in this reconciliation which I have drawn in table 8 would not be 0. So according to me, in this particular financial year of 18-19, when we'll be conducting our audits and filing our annual returns, in respect of the outward supplies, reconciliation of tax payable and tax paid would going to be something which will keep all of us occupied. And for this, we would have to actually ensure that the reporting in table 10 and 11, which was done in the earlier period, was correct. And that figures are actually coming in the financial year 18-19. If in case they are not error free, then necessary adjustments to ensure that the error free needs to be separately taken care of. And apart from that, any necessary adjustments of 1819 which has been done should also be looked at while finalizing this audit of 1819 filing of annual return. Then only we'll be able to actually have a correct tax paid figure. In fact, as a matter of good practice, what can be done is the actual tax paid, which assessors should have reported in table 9, could be separately annexed along with this GSTR 9C in this tabular format or in any other format which is convenient to the person who is drawing up those particular return forms, so that they are ably able to explain through their submissions that what figures they wanted to punch there. Next, when we come to reporting of RCM liability in GSTR 9, probably it is simplistic in a sense that instructions for reporting of inward supplies on which tax is payable by the person who is filing the annual return are quite clear. When you look at the instructions clearly say that aggregate values of all inward supplies on which tax is to be paid by the recipient should be reported in GSTR 9. That is to say that in 1718 also, the approach which was the approach which should have been followed with the instructions is that all liability of RCM, irrespective the RCM was paid late, not paid, or paid subsequently, should have been reported in table 4G, that tax payable and the taxable value there, and necessary adjustment of tax which should have been done. So RCM, to my mind, would not cause much of a problem if in case the instructions, the way they are written in the form, are followed. And the same should be followed in 1819 also, in a sense that irrespective of the amount of reporting which has been done in GSTR 3B in financial year 1819, in respect of RCM, may be parked away for the time being. An exact RCM liability which ought to have been paid by the SSC in 1819 should be reported in 4G, and then necessary tax which has been paid would auto-populate the tax which has been paid in table 9, and differential tax which should have been paid or excess paid, the necessary adjustment of the same could be done in table 10 and 11 in that regard. So I don't see much of a challenge in respect of the RCM reporting. In terms of input tax credit, the approach which we have followed as of now till for reporting the outward supply, that is to say, when I said that the impact of transactions which are reported in 10 and 11 in 1718, table 10 and 11 in 1718 should not be given in 1819. Probably when we try to apply that same principle in respect of those transactions which are reported in table 12 and 13 of GSTR 9 of 1718, and when we try to look at in 1819, maybe a different answer would come and a different type of reconciliation would be there. So just to explain a little background, that table 4 and 5 of annual returns and table 6 and 7 of annual return, they serve a different purpose. In fact, in the press release also, it was quite clearly explained that assessee can neither claim any input tax credit to annual return, nor they can reverse any input tax credit to annual returns. And whatever reversal has to be done, it has to be done separately through DRC 03. So that is to say that this table 6 and 7 are more or less of a reconciliation tables, but they are not the tables where what reporting ought to have been done should be there, but rather what figures are there in table 6 or table 6 which is coming in 6A, how those figures are coming in, ultimately what different it brings in. Now, because the reporting in table 12 and 13 was optional in financial year 1718, that is reversal of ITC pertaining to 1718 done subsequently, or any ITC pertaining to 1718 claim subsequently, it was optional. Because that was optional, it could cause some amount of challenge to us. One very interesting thing which a lot of people ultimately at the end of the filing season understood, that details in table 13 of GSTR 9, details in table 8C of GSTR 9, and details in table 12C of GSTR 9, they are interconnected. In fact, in majority of those cases, these details should ideally match, and there should not be a difference in these three tables, except for the case that in table 13, probably any credit of reverse charge which has been claimed subsequently by assessee relating to that particular financial year can be reported in table 13, but same cannot be reported in table 8C. Apart from that, these table 13 of 9, 8C of 9, and table 12C of 9C, they are more or less have the same value, and consistency should be there while reporting the details here. Okay. Now, it is very important that we look at what is written in respect of table 12 and 13, because the first question to answer here in respect of when we are filing the annual return for 18-19 is that if in case, let's say, I have reported some figures in table 12 and 13, am I again required to report that when I'm filing the annual return of 18-19 in table 6 or 7? And one thought which would also come to our mind is why government took this conscious decision of keeping these details of table 12 and 13 optional. I mean, why this was made optional when it was one of the most crucial information is in that annual return. So when you look at part 5 and when you look at it, how it is written, it says that particulars of the transactions for financial year 17-18 declared in the returns between April 18 to March 19. So it's a declaration in respect of the particulars of transaction for 17-18 that we have already seen in respect of the outward supply also. When you read table 13, let's say in this regard, there is a word ITC availed for previous financial year has been written. Now, just to digress a little bit, I'm sure all of us are aware that there are a lot of notices on section 16 subsection 4 in respect of input tax credit, all those returns which have been filed after due dates, and those returns having the amount of ITC return written in the table 4 of GSTR 3B, and department has issued show cause notices to say that those credits are now time barred in respect of 16.4. Now, in all those show cause notices, the word which has been used in the show cause is ITC availed. Whereas, if you actually try to read section 16 subsection 4, it uses the word ITC taken, entitled to take. So there are two separate words which are there. Now, why I am saying this here is that in table 13 also and in table 12 also, the word availed has been used and word taken has not been used. So that brings us to a point where we are trying to explain that probably this availed has a meaning which may have a different meaning than ITC taken. And this doubt also gets that gets some support when you read table 6. So table 6 also uses the word as to say details of ITC availed during the financial year. And when you read 6A, probably it goes a step ahead to say total amount of input tax credit availed through form GSTR 3B. So precisely all those who have conceptualized this form, they have conceptualized with an understanding that input tax credit is availed through GSTR 3B. I would park that word taken, that the discussion which I brought in respect of 16.4 for a later slide. So it is conceptualized by them that input tax credit is availed through GSTR 3B. And if in that context, when we read this form and when we go back to the table 12 and 13 which is there, it gives us a kind of a clearer picture that why table 12 and 13 has been made optional and what impact it has when we are punching data in respect of the supply, in respect of ITC in table 6 and 7 in financial year 18-19. So basically 12 and 13 is only an informational table. This table does not have any impact in terms of the mathematical addition or deletion when we do the figures in respect of ITC in the annual return. So it was only a disclosure which was given in table 12 and 13, that is particulars of the transactions pertaining to 17-18. And however, they are saying that ITC which has been availed for previous financial year in the period between April 18 to March 18. So precisely, if you try to interpret this, it is trying to say that all the ITC which has been availed in your GSTR 3B during April 18 to March 19, which pertain to 17-18, needs to be disclosed here. Now, this is in respect of 17-18. When we try and come to 18-19, and when we look at table 6 says in 6A, what they are trying to punch is amount of input tax credit availed through GSTR 3B. Hence, precisely what they are trying to say is that whatever credit which has been availed through GSTR 3B, irrespective it was for that financial year 18-19, irrespective it was for financial year 17-18, or irrespective it was for any other financial year, what there has been availed in the returns has to be reported in this particular table 6. And that's the heading of this table is also quite clear. And when we look at this, and we also look at the part 3 instructions which are returned, it kind of gives a sense to us that all the details which have been punched in table 12 and 13, if in case they have been punched in the previous financial year, they have to be reported in table 6 and table 7 for the financial year 18-19. It is an altogether different approach which needs to be followed when we compare it with table figures which are reported in table 10 and 11 in respect of the outward supplies. So in respect of outward supplies, the understanding which we developed was that in respect those figures which are already punched in 10 and 11, they need not come in annual return of 18-19. But when you look at details which are there in 12 and 13, they ought to come in table 6 and 7 wherever applicable when we go to filing of annual return for table 6 and table 7. And I'll explain it with an example. So let's say that there is the ITC which was there in the books of accounts in 17-18 was 100, and ITC which was there in GSTR 3B in 17-18 was 80, and 20 was actually shown in the returns at a later point of time, that is not up till March 2018. Now that reporting in 9 which would have happened in 17-18 would have been quite simple. 6A table would have auto-populated as 80, 6B would have also been 80 in that regard, and table 13 for all those who opted to punch data in table 13, then ITC in respect of earlier financial year which was mentioned in subsequent returns would have been 20 in this regard. Now when you take these figures and you come to 18-19, in a sense the reporting which needs to be done for 18-19, so assuming that input tax credit in GSTR 3B is 150, which has been punched by the SSC between April 18 to March 19. And in that 150, that spillover figure of 20 is also there, which technically should have been punched in March up till March 2018 in GSTR 3B, but has not been punched, and it has been punched subsequently before March 2019 in that regard. Now, applying that particular aspect which I had just explained. So applying that aspect which I had just explained, probably the correct approach in this regard would be that we write 150, which is auto-populated in table 6A, that is the total ITC which is coming from table 4A of GSTR 3B. Table 6B, in which we have to punch the data in respect of inward supplies, that should be 130 plus 20, that is 130 of current year, and 20 which although pertains to previous year, although which has been recorded in books of accounts in previous year, but because the ITC has been availed through GSTR 3B in current period, and first time it is coming in returns in this particular year, that 20 should also come here. This would take 7J figure, which comes after all the other adjustments for the timing, which I have kept them as constant. 7J would come as 150 in this case. Now, a question would come, then what will happen when we will go to table 12 of GSTR 9C, where we are going to actually match the figures of books of accounts, and we are also going to match the figures which is coming from annual return. In that case, obviously, the table 12A, that is ITC as to books of accounts for financial year 18-19 would be 130, but not 150 because 20 has already been recorded in financial year 17-18. In this case, 12B would come into picture, where ITC booked in earlier financial year but claimed in current financial year, that 20 should be punched here, so that the total of 12D in that regard would be 150, and figure which is coming from annual return 7J would also be 150, and there would not be any reconciliation difference. So that principle of 12 and 13, why it was optional and why it has to be reported again in annual returns of 18-19 would actually get validated when we look at table 12 of GSTR 9C, where if in case this approach is followed, there is not going to be any difference in that regard. Now, look at the other side of it when there is a reversal, in a sense that excess ITC has been punched in GSTR 3B in 17-18, and reporting in 10 GSTR 9 reporting would have been that 6A would have been as 120, and 6B would also been as 120, and all those who have filed punch figure in table 12, they would have written as reversal made in subsequent years in respect of ITC availed in the previous year as -20 in that regard. Now, When you take this figure of minus 20, that is excess credit which was there in 17-18 and reverse, then when you come to GSTR 9 of 18-19, that is this current financial year, we have to see table 7 which will come into picture of GSTR 9. And when you read the instructions for table 7 which is given in the form, the instructions quite clearly say that details of input tax credit reversed due to ineligibility or reversal required under specific provision shall be declared here. And then you see there is 7H which is other reversals. So in that regard, this 7 table also kind of sense gives an understanding that whatever reversals has been done in that particular financial year of 18-19, irrespective it pertain to which financial year, the same should be done in 18-19 only. So when you take that example and you try to punch the figures in the current GSTR 9, in that sense you see that in table 6A, it will be 150, 6B will be 150, 7H reversal, that is reversal for 17-18 done subsequently. If it has been shown as a reversal would be 20, and figure would be automatically 130, which would be carried forward from the annual return. Since the credit in books of accounts in 18-19 would any which be 130, that would be the correct credit. There is not going to be any difference, and in that sense also the figures would match and there will not be any difference in that regard, which should be reported in table 12 of GSTR 9C. Last example in this regard, which is kind of a ticklish is a tricky example in a sense to say that where, and this approach has been followed in a lot of the cases where the reversal has not been shown separately in GSTR 3B, but reversal has been done in a manner that the credit which should have been punched in table 4A in GSTR 3B has been punched by a reduced amount. So like you take this example in the given case, that in this case in 17-18 there was an extra credit of 120 which was taken, and what has been done with that 120 credit is that in GSTR 3B the credit has been mentioned as 130 in that case. So in this case probably the answer would be in that respect that the figures are probably wrong in a sense that it should be not 130 and 150, it should be 110 and 130. The answer would remain same, but it should be 110 and 130 in that respect. So 6A, the credit which would have auto-populated is not 130, that is credit of 18-19, but minus 20, that is 110. In this case, the credit which has been actually claimed by the assessee or availed to returns is 130 only. But because the amount of 20 of earlier period has been adjusted, so we should not do that in 6B. The correct amount of inward supply should be returned in GSTR 6B. And next, the necessary reversal which should be shown at the correct place in GSTR 9, that is in 7H of 20. And then the answer would remain same as 130 only, which came at the earlier example. So according to me, in respect of ITC, these are going to be the spillover effects in respect of table 6 and 7. In respect of table 8, the lesser said is better in a sense that this table 8 of reconciliation of GSTR 2A is still an informational table. It should not and it will not, at least in respect when you will be filing your annual returns, would not affect your tax liabilities, though it has become a basis for at least state officers or SGST department to issue the scrutiny notices where they have said that there is a difference in GSTR 2A and 3B and we would like to have a reconciliation of the same. Though that reconciliation ultimately would not serve a purpose, but they are correct in exercising of their power where to say that they understand, they have a reason to believe that there is a discrepancy in the return which has been filed at the SSC in form GSTR 3B and they would like to further investigate it. However, when we are taking these figures in table 8, one thing in fact after the retrospective amendment in rule 30, not retrospective amendment, but after the amendment which was brought in rule 36 of rule 4 in respect of 10% and 20% matching, this 18-19 matching of 2A also becomes diluted, where a question would come in anybody's mind to say whether my right of credit or entitlement of credit, which is there in 16.2, is restricted if in case the credit which I have taken in my returns is not appearing in my GSTR 2A, because there is no specific or clear mandate to say that for 17-18 and 18-19 that matching was important. In that sense, view can be taken that only it is an informational table. However, one question which I'm sure all of us have taken care well while filing 1718 is that the figures in table 8E and 8F, that ITC available but not claimed, or ITC available but ineligible, those two figures were not required to be punched compulsorily. In fact, they have been left blank, and at best, according to me, in 1819 also they should be left blank, and no tinkering with those figures should be done in respect of table 8 also. So table 8, more or less, the strategy to file the same remains the same. It would not have much of a change in that regard. But there is one very interesting thing which might come up in respect of table 8, where because of again the spillover effect, there can be a situation that there might be a difference or there might not be a difference. In terms of when you try to actually reconcile the figure, if in case you're lucky enough to find that figures which are coming in table 8A belongs to you and you're able to find the source of it in respect of it belongs to which invoices. So let's say the table in table 8A, the figures which are coming in what as 150, that is total credit. So scenario 1 and scenario 2 are different. Keeping the example constant to say that actual credited books of accounts of the assessee is 130 only and not 150, then scenario 2, which you see on your screens, is that in 8A figure is coming as 130 and there is a spillover effect of 20 from the previous years, the credit which has been availed to 3B of relating to previous year in current period. A situation would come, then it would say that there is a difference of 20 rupees in that regard. However, frankly speaking, this is no difference of 20 rupees in this to say, because the credit in respect of 130 has been properly taken and claimed and availed as 130 only. It is only that representational impact which is there in 6B due to the approach which we have followed, where we have included the figures of table 12 and 13 of the previous GST and 9. Because of that, this 150 is coming here. However, if you look at scenario 1, and there is no difference. If ITC as per 8A is 150, and because figures in 6B is also coming at 150. According to me, this is a wrong representation, because if ITC 8A is coming as 150 and ITC pertaining to 1819 as per books was 130 only, then probably it is actually an indication that though there is no difference, but there is a credit of 120 which is coming in GSTR 2A, which either does not pertains to the assessee, or if it pertains to the assessee, the same has not been taken by the assessee in his books of accounts and also in his GST returns, which needs to be further investigated. So the impact, the spillover impact would have be there in GST in table 8 also. That is to say, how we are punching figures in 6B would actually determine figures which are coming in table 8, where a no difference might actually be a difference, and a difference which is coming might actually not be a difference. So it leads to a very funny situation as to say that the scenario 1, according to me, is an incorrect scenario, and scenario 2 is also incorrect, where practically in scenario 2 there is no difference, and in scenario 1 there is a difference. Now that brings me to the next point of DRC 03, and DRC 03 has a role to play in financial year 1819, because department started using this DRC 03 to the greater extent in 1819, where it asked assessee to reverse the ITC for various reasons best known to them, and they started giving notices in respect of maybe in terms of the scrutiny or otherwise, or where in terms of any search or anything of that sort, any transaction was identified there, they asked the assessee to pay tax and assessee had paid the tax, or maybe notices in respect of e-way bill, which has a huge role to play while doing the audit and filing of annual return for 1819. In this regard, one approach or one caution which needs to be followed is that, which needs to be taken care of specifically, is that if any assessee has actually paid a tax to the DRC 03 which pertains to a supply, and that supply has not been reported in GSTR 3B, but it has been admitted by the assessee that on that supply tax was required to be paid, then in that sense, by identifying those supplies, necessary reporting should be done in table 4 for those taxable value and the tax in that regard. However, again, it will lead to a situation where taxable value will be higher the tax payable would be higher. And when you compare it with tax paid in table 9, because tax paid would only flow from GSTR 3B, there is going to be a difference in that regard, where that difference would again needs to be separately reported when you go and file your GSTR 9C. That brings me to GSTR 9C. That is, what impact would be there in 18-19 of various transactions or whatever things we have done in 17-18, or what new things which we have to look for while we will be filing this reconciliation statement. So this 9C, it has, all of us are aware that it has three parts: reconciliation in respect of turnover, tax liability, and input tax credit. The first point is to say is that, again, I believe that reconciliation of turnover would not be a very difficult task, or it would, or at least it would not become difficult because of the reporting which has been done by us in 17-18 in 9 or 9C. Because turnover matching would come in 5A table from the books of accounts, and the value of outward supplies which we have punched in GSTR 9, they are also on the basis of the outward supplies made by the assessee, on the basis of the outward register maintained by the assessee, and making a necessary adjustment in that regard in table 10 and 11. So, and I believe that unnecessary additional challenge would not be posted in respect to the matching of turnover. However, again, in respect of tax liability, I realize there are going to be few things which all of us would have to necessarily take care of. And 2 or 3 new things in this regard would be, for this year, would be at least matching of TDS and TCS claims. So as all of us are aware that TDS under GST and TCS collection under GST was made applicable from 1/10/2018. So for that period of 6 months from October to March, some of our clients might have a TDS credit coming in the cash ledger and TCS credit which is coming in the cash ledger. Mind you, because it doesn't come in the credit ledger and it is treated as a credit entry in the cash ledger, so it can be used as good as a cash, like cash can be used for payment or setup of the liabilities in that regard. Whether TCS and TDS reconciliation would be a challenge, this question has, it can be answered in 2 parts, as to say, at least when we will look at reconciliation of tax liabilities, which is there in GSTR 9C, I don't see a much of a challenge in that respect, because in GSTR 9C, what we actually match is tax payable as per books of accounts and tax payable as per GSTR 9. So to that effect, practically speaking, that tax payable would not have an implication in respect of TDS and TCS, and hence when we will be filing in part 3 table 9 of GSTR 9C, there would not be much of a problem in that respect. However, when you would actually try to compile the figures which are there in books of accounts, in that case, definitely some challenges can arise. Like, for example, an assessee might be doing accounting on the basis of the transaction of supplies which it is affecting, and accordingly might be booking the TDS and the TCS credits accordingly in his books of accounts. If that assessee is not maintaining a separate account of those TDS and TCS credits, and those TDS and TCS credits are virtually going to the ECL, electronic cash ledger, without matching them with what is coming on the GST portal, and without accepting or without checking whether actually the person who is required to deduct or the person who is required to collect has actually made necessary compliances on GST portal, then the figure of TDS and TCS, which is coming in books of accounts, would not match with the figure of TDS or TCS credit entries in the cash ledger. And to that effect, probably the details of tax, the cash or the balance in ECL, which is in books of accounts, and balance of ECL on the portal would not match. Though there is no reporting for that in respect of the same in the reconciliation statement, but still, because we are conducting the audit and we need to have a reasonable assurance about the books of accounts which we are auditing, hence in that respect, it is advisable that the necessary TDS and TCS compliances of confirming and accepting and necessary entries in that regard is done by the assessee. It goes without saying that necessary entries for TDS and TCS for the accounting perspective should be done in 2 separate accounts, where one is for the memorandum purpose to ensure that necessary recording has been done, and once it is reflecting on the portal, then it may be shifted to the main account in that regard. That brings us to the next point, which has some value from the previous year also, and that is, this is kind of a mistake which invariably out of every three assessee, one assessee would have made, that is payment of wrong taxes. In a sense that there can be three possible scenarios in respect of wrong payment of taxes, or maybe reporting an annual return, or maybe reporting in the books of accounts. So one of the three possible scenarios which can be is that one is that IGST has been charged on the invoice and IGST has also been collected from the customer, but the problem is assessee has wrongly paid tax, CGST and SGST. So in his books of accounts, he would have IGST as tax, whereas in the annual return, he would have tax at CGST and SGST. And when he'll be filing table 9, he would come out the difference where there'll be excess at one side and shortfall at the other side. This is quite a comfortable situation to actually dwell upon and to get the corrections done, where there is a circular in this regard 2626 of 2017, which clearly says that assessee is only required to pay the correct tax, and whatever excess tax he has paid on the wrong head, he can actually get a subsequent adjustment of it. So for this, no necessary document is required to be issued, but only probably a recommendation of payment of correct tax is required to be made by the auditor in part 5, or maybe itself in table 9 of GSTR 9C, and compliance in that regard has to be done. However, a situation would arise where a wrong tax has been charged on the invoice, but the correct tax has been paid by the assessee on the portal. So where it states that in books of accounts, CGST, SGST is wrongly mentioned, but whereas correct tax is there in the annual return, which is coming through GSTR 3B. In that regard, necessary document has to be issued by the assessee, that is issuance of credit note and issuance of debit note. So issuance of debit note for correct tax and issuance of credit note for the wrong tax charge. It goes without saying that when the credit note has to be issued, the timelines which are given in section 34 needs to be honored, and those credit notes should be issued within those specific timelines. Third is a little ticklish issue, in a sense that it is that issue which has a impact and where the discretion can be taken by an assessor, or a call has to be taken along with the auditor, where the CGST, SGST has been charged from the customer, CGST, SGST has been paid, but the problem is that transaction should have been variable with IGST, that is, there is problem of the place of supply, and an intrastate supply has been treated as an intrastate supply or a vice versa. Now, though there is a clear mechanism and a provision in this regard, that is section 77 of CGST Act and 19 of the IGST Act, the problem is that the 77 and 19 say that correct tax needs to be paid, and the wrong tax which has been paid, a refund of that can be claimed. The question which arises is, who is going to sanction that refund, and who is going to actually identify and ensure that what place of supply should have been, and whether this supply is an interstate supply or an intrastate supply. So because if CGST, SGST has been paid and a refund claim is filed before a state officer, then practically speaking, though there is a mechanism which is given in the law, practically speaking, it would be very difficult to, unless it is a straightforward case, it would be very difficult to convince the officer in that respect to say that this specific amount of tax should have been paid. Secondly, one more challenge which we will face is that if in case the credit of that tax has already been claimed by the recipient, and let's say that credit was valid, irrespective tax paid was wrong, but the credit has been claimed, and then the necessary correct tax is paid, then it would lead to a situation where the credit claim of the receiver would also be required to be reversed in that sense, and then whether the refund would be given or not would also be questionable in that sense. Then this brings to us to a point where what is the scope of our audit, and if we practically look at it in a sense where the taxes in the books of account and taxes in the returns are matching and they are proper, then whether it is on a scope to check what is the place of supply. And when you try to look at various literature in this regard and various interpretation, you will be tilted to answer no for this particular question, to say that probably place of supply is that subject which is outside the scope of our audit until and unless it is apparent from the books of accounts or there is a blunder which has been done in that respect, and it can at best be left for the purpose of assessment at the time of assessment, and no reporting in this regards can be done. I've already discussed table 12 and 14 probably the impact would remain same. I'm sure all of us had a problem in respect of reporting details in table 14. The details required to be reported in table 14 were made optional. However, I would understand that at least table 12B, the figures in table 12B and 12C, which have been made optional, that option of not punching the details should not be opted, and an effort should be made to ensure that table 12 at least is punched properly, because that reconciliation actually serves one of the important aspects of input tax credit reconciliations, which is going to be highly debatable in the times to come, and it is going to have an impact in future. So at least table 12 should be punched properly in that respect. Maybe a call can be taken in respect of table 14, because reporting of figures in table 14 is a very tedious task, and all of us, I can say at least all of us, have comforts when we are punching the figures in various tables, but table 14 is that figure where the comfort level seems to be not at that high when it is compared to other tables which we are reporting. This question in terms of audit would come, and I think in 17-18 this question would have come, and this question would again come in 18-19. In fact, the awareness for place of supply in this current year of 18-19 has increased with the passage of time, and with clarifications of law coming and various interpretations happening. So when you'll be doing the audit, and if in case we are actually also looking at matching of figures which are there in GSTR 2A with the credit which is there in the books of accounts, we would kind of see that there will be instances where a credit of IGST has been claimed, where technically that IGST invoice has been issued properly. The only problem is that place of supply. For example, somebody in Maharashtra has claimed an invoice. The invoice has been issued by a person sitting in Rajasthan, and the invoice has place of supply as Rajasthan with IGST. Now, Maharashtra person has claimed the credit with an understanding, because that IGST is mentioned, the invoice is entitled to the credit. The question would arise is whether it is a proper credit or whether this credit needs to be reversed. If you look at the substance and the philosophy of the law, then philosophy of the law is in respect of the ring fencing of the credits, and according to that ring fencing of the credits, technically the place of supply in that invoice is incorrect, and the taxes would not flow the way they should have been flown from Rajasthan to Maharashtra. However, from the receiver's perspective, and when we are doing audit of that particular recipient and when looking at our observations and recommendations, when you would look at the law, you would not find a single instance in the law which talks about a situation where credit should be reversed, where place of supply in GSTR 2A is incorrect. I understand that in respect of an invoice, place of supply is required to be mentioned, and that's one of the important, out of 5 ingredients, one of the important ingredients which needs to be checked when once is claiming a credit. However, it still doesn't say that place of supply should be that same state in which you are there and you're claiming the credit. So in that regard, probably a call can be taken by an auditor, and an observation in that regard might not be required to be maintained, and this issue can also be contested by the assessee at a higher forum. But 8A of the table, when you look at it, that doesn't auto-populate a figure which does not have the place of supply matching with that of the state code of the person who is filing the annual return. But again, that is to say that's a GSTN made law, but not GST made law, and we are conducting audit, keeping ourselves within the circumference of the GST made law, but not the GSTN made law. The second issue, which I'm sure where probably our intervention would be definitely required, is that CGST, SGST credit has been claimed of an invoice issued by a person sitting in Rajasthan, and the credit has been claimed by a person sitting in Maharashtra. In that sense, that it is quite clear that at least SGST credit has to be definitely reversed by the person, and recommendation in that regard during the course of audit should be given by the assessor, should be given by the auditor, because the law in respect of SGST in Rajasthan and SGST in Maharashtra are altogether different, and as Maharashtra SGST law doesn't allow credit of SGST Rajasthan. But maybe in respect of CGST, looking at the quantum and looking at the risk appetite of the assessee, and within the mandate which is given for us during for the audit, a conscious call can be taken by the auditor in consultation after obviously making aware the consequences of same to the assessee, that if in case the credit of CGST the assessee wants to retain and wants to contest it out, keeping in mind that CGST law is common throughout the India, maybe a call in that regard can be taken. However, it is needless to say that there is an advance ruling of Rajasthan in this regard, which clearly says that such credit cannot be taken, and they have given reference of section 1 of the CGST Act and IGST Act in that regard. But because those advance ruling have no judicial precedence value on for the audits which we are doing until unless it is binding on the person of whose audit it is done, so a necessary call in that regard can be taken. This brings me to the second last topic, which I would like to take, and which is one of the important topics and impact which is going to be there in GST audit of 1819 is e-way bill and its impact on GST audit. So friends, when we did audit of 1718, all of us did not had this e-way bill facility available. Though in some states, like for example, state of Rajasthan, for specific months from November 2017, e-way bill were operational, but that was not completely operational and only it was applicable on specific conditions. From 1/4/2018, e-way bill was made applicable pan-India. So irrespective, you are doing audit of a person who is sitting in Rajasthan or a person sitting in Bangalore or person sitting in Maharashtra, this e-way bill and its reconciliation with the books of accounts would definitely throw new avenues for us to further audit and see and to get a reasonable assurance. The word reasonable assurance I have used twice during my deliberation. That is to say, because ultimately all of us have taken call in respect of the scope of audit, that what is the scope of audit. But at least I am clear in my mind to that extent that though the reconciliation is of prime importance and our scope is around that reconciliation, but because we have to see the documents and the related records in that regard, so I cannot ignore the documents which are available, which are statutory documents within the circumference of this GST law and its impact on the books of accounts and probable disclosure the assessee has made. So this e-way bill reconciliation is going to be quite important. Though there are some departure in the practices which are followed state-wise, and that has to be taken care of when you take up the audit assignment of a assessee of a specific state, where in some cases this the value of consignment limit, that 50,000 rupees has been relaxed, or in some cases that limit has been reduced in specific type of transactions. In some cases or in specific states, like for example the state of Madhya Pradesh, the e-way bill is required only on specific type of commodities, but it is not applicable on all type of commodities, movement of all type of commodities. So maybe that variation has to be kept in mind. But why e-way bill is important? Because reconciliation of e-way bill data with GST inward and outward details in inward and outward register which assessee would have prepared, or we would have asked him to prepare and present before us, would throw a lot of insights to us in terms of we would be able to identify the output supply pattern. We would also be in a position to identify what is the time lag between the invoices which have been issued and goods have been dispatched, and whether this process is followed in a altogether different manner where dispatch is happening prior to issuance of a notice, and also the data which is there in the e-way bill portal on e-way bill which have been issued maybe by us or by any other person, and data which is there in GST returns, what reconciliation or what non-reconciling items are there, and is there something in which for which we have to deep down inside. So why am I saying this is because though the data which is available with us at the e-way bill and the data which is available in respect of GST records and GST returns, they both serve a different perspective. They both serve a different mindset, and they are both meant for different provision and requirement of fulfillment of different provisions of the law. However, though these differences are there, these differences definitely should pop up few questions in our mind. Like for example, e-way bill, it is prepared by the person who causes the movement, whereas GST records and returns specifically is in respect of outward supplies is made by the person who is actually making the supply. So person causing the movement and person making the supply, if they are different persons, probably in that case, it becomes a case for us to identify that whether the location of supply and place of supply in that regard has changed or should be checked in a sense to check that whether the tax liability was proper or whether a registration requirement was there or not. Then second question would come is there is a monetary limit of 50,000 which is there in EABL, which is why, however, the same is not there in respect of GST outward supplies, and same have to be complied with even for rupee 1 also. But the values which are there in EABL and values which are there in GST returns, if those values are different, this definitely should lead us to a question to analyze whether the difference in values as per the within the provisions of the law, or is there a punching error, or if in case we are relying on the internal controls of the organization to say we are posing a fail on the documents which have been produced before us. But when we reconcile and we realize that there is a difference, then whether those internal reliance on internal control needs to be checked or not. Then third point, which is kind of an interesting point to say, that EABL is not required when there is no movement, and outward supply is not outward supply reporting is not required when there is no supply. So movement and supply, generally it has been treated and they are synonyms of each other. They are altogether different concepts. And movement may include supply, may not include supply. Supply may include movement, may not include movement. And accordingly, the type, if the assessee has not understood this difference and made improper documentation, probably it will lead us to a situation to realize that the tax liability has not been discharged properly. And then that is to say, apart from other points, I think one very important point from EABL data which would get is the second last point, that is the document number. So though in financial year 18-19, a check was introduced in respect of that EABL website, wherein for a particular financial year, EABL could not be prepared on one, could be prepared only once on a unique document. However, for the financial year 18-19, that check was missing. So in 18-19, you would find a lot of instances where on a specific invoice, maybe by mistake or oversight or otherwise, an EABL has been prepared for more than one time, whereas the reporting in GST return has been done only once. Now that is to say, friends, that definitely is one of the important points which all of us, we should ensure that the data which we are reporting in GSTR 9C and any observation which we are giving, and then we are saying that books of accounts are free from material misstatement, this brings out that particular situation where there is a possibility of misstatement in the sense that maybe the movement would have happened on the same document once or twice, or maybe more than that, and reporting has been done or only once, or vice versa. And this also brings us to an understanding that EABL is prepared by a person who is definitely not related with the compliances of the GST returns. And we are two separate persons with two separate mindsets, with two separate objectives, where one person is in charge of the logistics and looking after movement of goods, where other person looking after the compliances of the law. Since we are at that side where we are also looking at the compliances of the law, in that sense is to say that business is moving with the same, in the same manner, the way in which we are doing the compliance, this particular reporting needs to be done. Then one question which comes up, and that's a very important question, is how are we going to get this EABL data? Because if you go to the website and you try to download the data, it would only throw numbers only for 5 days at one point of time, and it becomes a very tedious task as to say that the report has to be taken for 5 days every time, and we have to put our manpower and resources in that regard. Friends, in that regard, I think ASPs are providing a good solution where in a sense what they can do is that they can help us bringing us the data for 1 year at a time, where what they do is that through their internal software, they put this loop of 5 days continuously 5-6 times, and they're able to fetch the data. So if in case you want the EABL reports properly, and the details which you see on the screen, EABL reports are generated in these three particular manner, where details of outward supplies, or where EABL is generated, which is assigned to the transporter, or where EABL is generated by others, and all these fields are available. these fields can definitely, with the use of Microsoft Excel and other tools, can be compared with the data which we have, and necessary results in this regard can be taken. So at least for this e-way-bill reporting, until unless a support is directly provided by the government while doing the audit for 1890, we might have to actually look at the support from various ASPs which we are using, depending upon what kind of services they are providing, to take this particular data and necessarily make reconciliations in that regard. Next question which comes is that one thing which all of us should be very clear of, that there are few things which are not available in e-way-bill, or they are not reflected, because in a sense there are few specific transactions which are not related to the movement, or there are transactions which are happening after the movement has taken place. And these are those things which would not be there when you would look at the e-way-bill data. And for that, you would have to look at the other sources, in a sense, to say that these credit note, debit note for rate adjustments, or for those supplies which are not involving the movement, and specifically bill to ship to supplies, where there is only going to be one e-way-bill data, because e-way-bill has 4 fields which says bill from, ship from, bill to, and ship to. Whereas in respect of an invoice which we issue, generally it is from, bill from, and bill to. Ship from and ship to are the fields only for the purpose of information, but that doesn't change the tax character to some extent, and that's why probably that would be at a different footing when you would look at the details in respect of bill to ship to supplies. So once we understand the business and we realize that there are bill to ship to supplies of a particular assessee which are there, in that sense that there is going to be a difference in respect of e-way-bill and the data which you would have in your books of accounts. So on random basis, that testing, if that is done and a reasonable assurance is taken, that would definitely serve the purpose for us. Wrong punching of e-way-bill data by an outsider third party which does not relate to us, and that has gone unnoticed, because the same has the reconciliation of e-way-bill has not been done by the assessee over the period of 1 year, is something that might crop up during the course of audit in 1819. And interestingly, this data is also available with the department, and at least in this field, they are proactive than the assessees to say that the data which is available with them is much more broad in the horizon, and at the same time that data is that data mining in respect of e-way-bill kind of has improved over the period of time, as in when we have seen the notices which are coming from the department. So this aspect needs to be seriously taken care of, where in management representation letter, this should be specifically taken from the assessee, where details of supplies made by some another person upon us, or vice versa, which is coming in the e-way-bill portal of the assessee, or the report which has been downloaded, which is not there in the books of accounts, to which assessee denies, unnecessary cross-checking or necessary additional checking, if that is possible, needs to be done, or at least an MRL in that regard should be taken by the assessee to ensure that it has been clarified by the management that the data does not belong to us and it does not alter the tax liability which has been reported by the assessee. One very interesting point which would come up while we'll be doing the audit in 1819 is that what if assessee does not have a proper log of e-way-bill, and whether it will hinder or hamper the input tax credit claims which have been made by the assessee. In that regard, a question would arise that if, let's say, some inward supplies which have been made by me, and that inward supplies are not, I am not able to see those inward supplies in my e-way-bill portal of the report which is coming to me, does that mean that the goods have not reached to me, or I have not received the goods, and the conditions which are there in section 16 subsection 2 have not been followed? Well, the answer to this is quite simple, as to say that though e-way-bill should have been a must requirement wherever there is a movement of goods, and specifically which is supported by an invoice on which credit has been taken. However, nowhere section 2 links with that unless the e-way-bill records are available, the assessee cannot claim the credit. So the condition of 16.2, if e-way-bill data is not available, it can be checked through other sources, maybe in terms of if the company has the policy of maintaining material receipt note or a transportability or a stock record in that regard. It goes without saying also that in past there have been judgments that if there is a discrepancy in respect of transport details or documents in that regard, but if those details can be explained properly to other corroborative evidences, then the credit of the assessee cannot be denied. Maybe a reference of that can be taken, but definitely if in case givable record does not reconcile with the record of inward supplies which have been maintained by the assessee, the auditor, in my view, is required to go further and investigate and look for alternate resources to ensure at least that the conditions of section 16.2 are followed, if not with the givable data, but with other possible sources also. I would skip this GST audit report because all of us have, we know the scope and we are running out of time. I'll just take two important issues which would be of, which would, I am sure, would have greater importance to all of us. That is recommendation of interest liability in the 1819, where we are reporting about any supply or any tax on reverse charge which assessee has not paid. And because it has not been paid, and we as an auditor are recommending it to GSTR 9C, after that recommendation, the question which arises is whether we are liable to recommend for interest, and if so, if we are liable to recommend for the interest, should be on the gross basis or net basis, looking at the retrospective amendment which has been approved, recommended by the council in section 50, subsection 1. Now, because that retrospective amendment has not happened, one conservative view which comes is that the liability should be reported, and liability should be reported on the gross value. However, I have few points to counter that conservative view. That is to say that, first of all, we have a favorable judgment from Madras High Court, which in a very lucid and a clear manner tries to explain that interest, or why interest has to be paid only on the cash component, and why interest liability cannot be there, and it should not be there on the gross liability which has been not paid by the assessee, or has been paid at a later point. The second point, which is quite interesting, is that in fact the department which had issued the flurry of notices, in fact they are now also insisting assessees only to pay tax, that interest on the cash component which has been delayed or late paid, and they are not pushing for that the interest liability on the gross basis. Further, from the law point also, there seems to be some challenge where section 50 subsection 2 clearly says the manner of calculation of interest has to be prescribed, and when you look at it, the prescription has to come from rules, and as of now there is no rule as such which has been prescribed that how the interest has to be calculated on simple interest basis or compounding interest basis or anything of that sort. So that is also kind of explains the situation, as to say that interest liability, how it has to be calculated, that clarity in law is still missing. And if somebody would look at the GST Council minutes also, the intention of the Council during the recommendation and before that also, when they brought in the amendment to 50 subsection 1, before this retrospective amendment, was quite clear to say, when they said the tax has to be, the interest has to be paid on the net amount, where they were clear to say this, that interest has to be on the value addition. So the value addition is to that extent the tax which has been paid in cash, and beyond that, technically there should not be any liability to pay interest. So my view would be that probably interest is quite a subjective issue, and it should not be covered, or it should not be. It is not that straight simple. It more than a matter of fact. It becomes it's a matter of law and the interpretation about it. And during the audit, our trust should be on the facts which we can apply to the provisions of law, and that's why my view would be in that regard would be that liability to pay interest and recommendation in that regard may be for the purpose of recommendation not required to be done. In respect of ITC wrongly availed, in fact, it is a better case for the assessee to argue to say that 50 subsection 3 does not talk about wrong availment of input tax credit in general sense. It only talks about wrong availment of utilization only due to mismatching of credits which should have flown from GSTR 2, and due to lack of GSTR 2, that interest cannot be proposed. Second question which has cropped up in last year, and a lot of people have taken different views in respect of whether auditor is required to recommend liability for 180 days. So for 180 days, I think there are two things which from maybe auditor can, on the basis of it, take a call of not reporting anywhere. One is to say that the word used in section 16 in respect of this 180-day failure is failure to pay tax, and failure to pay tax and not paying tax is altogether a separate situation. So the auditor has to identify whether it has been failure, and that failure has to come from the contract. Beyond that also, maybe for auditor, which is a comfortable understanding to take is that, okay, let's say even if auditor is required to give that recommendation in respect of ITC reversal when payment to the vendor is not made within 180 days. However, when you look at Rule 37, which talks about the mechanism for the reversal, it clearly says that reversal has to be done through GSTR 2. Now, as on date, GSTR 2, it has not been discarded by the government. The only thing is it will come at some point of time. So at the point of time when it will come, at that point only the mechanism would come in, and that point only that reversal is required to be done, is required to be reflected. So maybe in that regard, a shelter in respect of rule language of Rule 37 can be taken, and auditor can save himself from going into trouble of looking at a various record and trying to find out, where all of us are quite clear that record has not been maintained. Last point before I close my topic is in this regard of this 16.4, where a question during the course of audit, which every assessee would ask an auditor, that, okay, I had this left out credits which you have discovered during the course of audit. Can I take that credit now? And that question, whenever it asked, all of us look at section 16 subsection 4 and we say, unfortunately, the time limit for credit has gone. Now, in the earlier discussion when I was doing, I said that when we look at section 16 subsection 4, it uses the word entitled to take. Whereas you look at all the show cause notices which are being issued by the department, or all the objections which have been raised by the department, nowhere they have used the word that you have taken the credit after, you cannot take, or you have taken the credit after the expiry of time limit. The words they have used is that you have availing the credit after the time limit. And that this brings out that there is this concept of availment and taken. When you look at the law very closely, it has been worded differently at different places. Like, for example, when you look at section 18 subsection 1 clause A to D, which talks about claiming of credit when somebody is coming from exemption to taxable, from composition to taxable, from non-registered to registration, it uses the word claim. It never uses the word avail. So whenever for the first time the claim for credit has to be lodged, in law the word claim has been used. Whenever the law wanted to talk about reversal of credit, you would look at it like, you may take an instance from 80 subsection 4 when it talks about reversal of credit in a specific instance. There they talk about that credit which has been availed. They do not talk about the word credit which has been claimed. They use the word credit which has been availed. In fact, in section 73 and 74 also, for issuance of show cause notice, the words in respect of input tax credit has been used as input tax credit availed and utilized or utilized. So in that sense, to say that law clearly identifies that there is an action of taking or claiming, and there is a separate action of availment. When you read all this with GSTR 9, which we had just discussed, table 6 also, in table 6, it has been very clearly mentioned that credit is availed through GSTR 3B. It never uses the word credit is taken to GSTR 3B. And section 16.4 is a restriction on entitlement to take the credit. And hence, then this brings out that the accountant's mindset that what is the process of taking credit? The process of taking credit is that I would receive goods, I would receive services, I would account them, and once I account them, then in my accounts, I will lodge a claim in my GST records. And that GST record which I am maintaining under section 35 read with Rule 56. In fact, when you talk about Rule 56 also, the concept of taking and claimed and availed there are separate documents, there are separate records in that record have to be prepared. So, whole in all, my point of view of saying this is, if in case the claim of credit has been lodged in the books of accounts by the assessee within the time limit which is given in section 16 subsection 4, there are a lot of judgments in the previous regime also that say that the non-filing of return cannot be based for rejection of credits and VAT credit. Plus, the words used in the section also help us in that manner to say that the credit can be taken if it is there in books, but it is not linked with the filing of the date of return. The others are the topic because I am overshooting my time, so I will not go into that. Finally, before I end, I would like to end by this, that on your screens, what you see, and if I ask you a question that what do you see, I'm sure all of us would have different answers. If some of you might say that it is some drawing which has been made which makes no sense, but all those people who will try to find out that maybe in last 1.5 or 2 hours, I was trying to make some sense, and they would also try to find meaning in this, and they would say probably it looks like 13 or it looks like B. Now the point is, when you are interpreting this B or 13, the point is, if you say that this is 13, or if you say that this is B, I would write it like this, and probably your answer would change. And if you say this is 13, I would write like this, and probably your answer would change. So what I'm trying to bring is that while we do the audit, what is important is our perspective towards things. If in case we are sure with our perspective, if in case we are able to make our perspective quite clear, I think approach to audit, whatever we are trying to apply, we somehow will be able to substantiate it. With this, I would like to again extend my gratitude to the Chamber of Tax Consultant and the Indirect Tax Committee for providing me this opportunity to explain my thoughts on this topic of in respect of 9 and 9C. I'll be happy to take few questions if in case they are there and the time permits. Thank you so much.
Thank you, Yash, for an excellent exposition on the subject. Your last example, your last slide of 13, it coincides with the date today, 13th of April. I don't know whether it is you have taken it based on this date, or it really coincides. But yes, this GST is going to be a perspective of how you are going to interpret the law, how each one of us is going to interpret the law, and how we are going to present our annual returns and audits. And Yash has done a marvelous job. He has taken us right through the concepts of what we had envisaged during the audits of 17-18, what could be the repercussions thereon on 18-19, and taken us through various